Hello and welcome to the lecture for part 2 of chapter 14. In this part of the lecture, I'm going to talk about bonds. So bonds are usually used when companies or public entities, like the state of Washington as an example, or SPSCC, borrows a large amount of money to construct a large asset. So as an example, the Washington State Department of Transportation issued bonds to pay for the second bridge between over the Tacoma Narrows. SPSCC issued a bond to pay for the health center, the gym that all the students can use. So it's used when it's kind of a larger amount than what one bank might be willing to loan. So it's for large amounts of money. That's why regular companies don't often get involved in issuing bonds, because they're not borrowing those kinds of sums. So a little bit about terminology. So a bond indenture, that's the underlying contract that the company issues that governs how the bond functions, how payments are made, what the terms are, all of that. The principal is the face amount of the bond. Bonds are usually issued in increments of $1,000, and it's effectively borrowing from the general public. So if I say I need to borrow $100 million to build a new factory to make electric cars, I could issue a bond for that, and people may choose to loan me money in $1,000 increments by buying my bonds. Individuals could do that as part of their investment portfolio. Other investment companies could loan me money. A wide variety of people could. There are term bonds, which all mature at the same date, or there are serial bonds where different portions of the bond mature at different dates, where it's staggered. There are convertible bonds, so bonds that could be exchanged for common stock, either at the request of the company or the investor. There are callable bonds, so that allows the company to pay off the bond early before the maturity date if they choose to. Another term is the contract or coupon rate. That's the interest that's noted on the face of the bond. Bonds pay interest either every 6 months, so semi-annual interest, or annual interest. And the way a bond will work is, let's say we issue $1 million worth of bonds for 10 years. If their interest is paid semi-annually, every 6 months I'll pay interest. That interest will be based on the face value of the bond and the contract rate on the bond. And then at the end of 10 years, I'll pay back the full amount. So that contract rate, that's the rate that I, as the issuer of the bond, agree to pay. There's also a market, and there's a typo there, sorry, a market or effective rate of interest. That's the interest rate that's being paid on similar bonds. So if I was choosing as a startup to borrow $100 million to build an electric car factory, the market rate would be, what are other similar companies paying for their interest? And so I would be judged relative to other similar companies. The face amount is the bonds that are selling at the amount to be paid at maturity. If bonds are issued at a discount, they're selling for less than face value. If they're issued at a premium, they're selling for more than face value, so above or below that $1,000 increment. So when companies issue bonds, they often, or organizations issue bonds, they often will hire consultants that will examine the bond market and tell them what interest rate they should issue it at. So it's any company, and I say company, it could be a branch of the government as well. They wish to or endeavor to issue their bonds where the contract rate is equal to the market rate. And if they do that, if they issue, say, a 6% bond and the market looks at that and says other similar companies are paying 6%, so that seems right to us, the collective wisdom of all the investors, then it would be issued at $1,000. It would be issued at face value. If instead I offered a rate that is less than the market rate, say the market rate is 6%, but for whatever reason I don't know that and I issue my bonds at 5%, now I'm offering to pay less interest than other similar companies are offering to pay, and investors know that. And so they're going to say, well, you're paying 5%, that's all well and good, but I want my 6% because that's what I should get based on my assessment of the risk of your company. So I'm not going to be willing as an investor to pay $1,000 for that bond. I may pay $950. Now, if I pay $950, I'm still going to get interest payments of 5% times 1,000. I'm still going to get $1,000 back at the end, but I'm only going to pay $950 up front for that. That's my way of getting a 6% return. The opposite could happen. I could choose, well, maybe I issue my bonds at 7%, so I'm issuing a contract rate that's greater than the market rate. Now people are going to fight with each other and bid up the price of those bonds because they're willing to pay more than $1,000 because they'll settle for 6% even though I'm paying 7%. So if the contract rate I'm offering is greater than the market rate, the bonds will be issued at a premium greater than the face amount. If I issue bonds with a contract rate less than the market rate, they'll be issued at a discount, less than $1,000. So let's first look at bonds that are issued at face value. So when I issue the bonds, I receive the cash. In this case, we have $100,000 in bonds, 12% contract rate, and the market rate is equal to that at 12%, and the term of the bonds are 5 years. When I issue the bonds, I get $100,000 in cash, and I create that long-term liability called bonds payable of $100,000. Now this bond pays semi-annual interest, so on June 30th, I will pay interest equal to $100,000 times 12% times a half a year. So $6,000 of interest. I'll record interest expense and I'll credit cash. I'll do that every 6 months for 5 years. Pay out that interest and record interest expense. When the bonds mature at the end of the 5-year period, I'll pay out cash of $100,000 and I'll debit my bonds payable to take the liability off my books. So that's straightforward. That's when bonds are issued at face value. And again, that's what most companies endeavor to do. If bonds are issued at a discount, then the amount of money that I receive is going to be less than the amount of money that I owe. So the initial entry there is going to be debiting cash for some amount less than $100,000, crediting bonds payable for $100,000, and then the difference between the debit and credit there is going to be a debit to discount on bonds payable. And that's going to be a contra account that's going to sit on my balance sheet next to bonds payable. Now I need to amortize that discount over the number of interest payments I'm going to make. So in this case here, I divide that discount by the number of interest payments I'm going to make. It comes to $359.40. So I'm going to amortize that discount. It has a normal debit balance, so I amortize it by crediting it. And you can see that has the impact of increasing my interest expense. So my interest expense when I've issued bonds at a discount is going to be greater than the cash I'm actually paying out for the interest payments. So I'm kind of spreading the pain of the fact that I didn't get as much from my bonds as I had hoped to. I'm spreading that pain over the 5 years through increased interest expense. Now the opposite is true with a premium. So when I issue bonds at a premium, I'm going to debit cash for more than I'm going to credit bonds payable for in the initial transaction. So the difference between debits and credits there will be a credit balance in premium on bonds payable. It has a normal credit balance, and again, it's on the balance sheet right next to bonds payable. So I also have to amortize that over the number of interest payments that I make on the loan, and I'll amortize that each time I make an interest payment. So in this case here, because it has a normal credit balance, I amortize it by debiting premium on bonds payable to reduce it each time. So when I get to the end, the maturity date on the bond, that premium account will go to zero. The same thing with the discount account will also go to zero. And you can see here, this has the impact of reducing our interest expense when I amortize that. So in that case, I'm spreading the benefit of getting more money than what I owe by having lower interest expense over that whole period. At any given point, the carrying value of the bond is going to be the face value of the bond. In this case, it was $100,000, either minus the unamortized discount, because remember that as a debit balance, or plus the unamortized premium. So I'm going to add unamortized premium, I'll subtract unamortized discounts. That's the carrying value. And the only reason that's really important is if I choose to pay the bonds off early. So that's called redeeming the bonds. So if I redeem the bonds, I'll look at what the carrying amount is at that point, and that will cause me to recognize a gain or a loss. So I'll determine, what do I have to do to pay off these bonds? What would be the amount I'd have to pay to get people to let me pay them off early if it's a callable bond? That may be written into the bond agreement, the indenture agreement, or it may be a negotiated thing. So if I can pay less than the bond carrying amount to get out of that debt, then I'm going to recognize a gain. And it's a little bit weird because it's different than a gain or a loss on selling an asset. If I owed you $1,000 and I came to you and said, I owe you $1,000 and I want to get that debt off my books, I want to pay it off early, and you told me, well, you know what, I need the money anyway, so I'll tell you what, I'll let you pay me $980 and then we'll call it even. Well, I'd be paying you less than what I owe you to get out of that debt. I'd save myself $20. I'd be happy. That would be a gain. If on the other hand, I owed you $1,000 and I come to you and say I want to pay it off early, and you said, well, I don't really want you to pay it off early, so in order to let you out of it, I'm going to require you to pay me $1,030. Well, in that case, I'm paying more than what I owe to get out of this debt. That's going to be a loss. So that's kind of how we think about gains and losses when we pay off bonds early. And you might ask, why would a company pay off a bond early? Well, interest rates may have changed. It may be beneficial for them to pay it off early if it's a high interest bond and then reissue it at a lower interest rate. That could be one reason. So the entries for redeeming the bonds. So in this case here, if I have a premium on bond payable, the first example there, notice I have bonds payable of $25,000. I have a premium of $1,000, so I have a carrying value of $26,000, and if I'm able to pay $24,000 to get out of that debt, I'll have a $2,000 gain. On the other hand, if I have bonds payable of $75,000, a premium of $3,000, so I have a carrying value of $78,000, and if I have to pay $79,500 to get out of that, I'll have a loss of $1,500. So recognizing a gain or a loss is required to let us balance the entry there. The last thing I want to talk about is just formatting for our balance sheet for this section. So notice under current liabilities, I have notes payable current portion. So if I have a long-term liability that a portion of it, maybe it's an installment note, so I'm making payments every year, the principal portion of the payments I'm going to make in this upcoming year is a current liability because it falls due within the upcoming 12 months. So for installment notes that are long-term installment notes, I have to recognize the current portion under current liabilities and the remaining portion under long-term liabilities. Of course, bonds payable by their very nature are long-term debts, and you can see here that we would recognize that less the unamortized discount. So the carrying value of the bond shown here is $484,000. It's the $500,000 less the unamortized discount, which will get reduced each time we make an interest payment. Now, when will that bond payable, could it become a current liability? Well, it can. In the last year of the bond payable, if it's due within the upcoming 12 months, it's going to become a current liability. So it'll move on the balance sheet from long-term up to current. That's an important thing to keep track of. So that's the end of the lecture for part 2. Bonds are a little bit tricky, so as you work through the problems, I'd really encourage you to do the practice problems before you do the homework in this chapter. And if you have any questions, of course, don't hesitate to shoot me an email. Thanks a lot. I'll look forward to talking to you when I lecture on chapter 15.